This is the second chapter on mortgages and lending. It's chapter 14, Financing 1, Conventional, FHA, and VA loans. And in this chapter, we're going to talk about issues concerning mortgage financing, including various payment plans. We're going to distinguish differences among conventional, insured, and guaranteed loans, as well as New Jersey's home buyer programs. So let's start off with home purchasers usually don't have all the money that's needed to buy a house. They need to get a loan. So why would anybody lend money? To earn money. And that's called interest. Interest is the charge or the rent to paid to use or borrow someone else's money. And it is calculated, the math of it is it's calculated on an annual basis. And that's how interest is calculated on an annual basis. Now, value equals 100%. Anytime we talk about the word value, we're trying to figure out all of it. So therefore, value means 100%. And the LTV is the loan, stands for loan to value ratio. It's how much the lender will loan you in relation to the appraised value of the property. So an example is an LTV of 80% means that the lender will loan you 80% of the appraised value of the property. So that means that the borrower needs to put down 20%. And if it's an FHA type loan, where they'll lend you 96.5%, and the borrower is required to put down 3.5%, the LTV on that is 96.5. Equity is the difference between the current value and what is owed on the property. And equity can be built in several ways: by paying down the debt. Usually, at the time that you purchase a property, your equity is equal to your down payment amount. And as you pay down the debt, you increase that equity. Market values just fluctuate, and when they increase, you could build equity, or you could force equity being built by doing home improvements, increasing the value of the property, thus building equity. So let's highlight there. At the time of purchase, the buyer's equity is equal to their down payment, and equity is the difference between the market value and what is owed. And here are the three ways to build it up. Why did I have it on a separate slide? Oh, okay. Okay, there you go. I'll just remove that equity statement from the previous slide if it's going to be over here. Okay.
Got it.
Okay, so I just went back to the previous slide and I just pulled out that whole thing about equity there because on this slide we talk about it. So it's kind of repeating the same thing, and that's unnecessary. So I pulled that out. Okay. And this text is entirely too large, so let's make it a little bit smaller. Come on, man. Here we go. There we go. Okay, so interest on page 268 is the rent the borrower pays the lender for the use of the lender's money. And the amount of mortgage loan in relation to the value of the home is called the LTV, the loan to value ratio. And that has increased from 40% in the 1920s to as much as 95 or 100% today. Wow. So if you were to go buy a house in 1920, you needed to have 60% of the cash to put down because the lender would only lend you 40% of it. And the payment periods have also lengthened from 5 years in the 1920s to as much as 30 or more today. Look, President Trump is even throwing around the idea of introducing a 50-year mortgage now. All right. Now, the only thing that that does is it brings down the mortgage payments. He's trying to find ways to bring down, to make things more affordable. He's getting a lot of people that are getting on his case. I'm watching on the news every day. His approval numbers are down because of the on the economy, and it's like, listen, you had Joe Biden destroying the economy, spending trillions of dollars over the last 4 years. Trump's only been in there for 8 months, and you expect him to fix everything like that. It's going to take time to fix it. He has been doing improvements. Remember when he first got elected, everybody was bitching and complaining about egg prices and gas prices. Well, gas prices are slowly coming down. The egg prices came down tremendously. Other stuff will follow. It takes time. Look at the medication. Some of these things that he's been working on are going to bring down prices a lot. It's just going to take a little time for them to get into effect. So bear with it. Look what he did in January, starting in January of this coming year. He put together that, what's it, that, what do they call it? The Trump marketplace for drugs, more affordable place to buy drugs, where he negotiated with the major drug manufacturers to bring down the prices of medications and such. So stuff is going to get more affordable. Relax. It takes time. It takes time. He's done a lot in this short period of time that he's been president. And some of those things you're not even seeing yet reflecting in the prices, but you will. Just give it a little more time. All right. So you guys got their interest. Interest is the rent the borrower pays for the use of someone else's money. And the LTV, that's the loan to value ratio. It's how much the lender will loan you in relation to the value of the home. Okay, so
Yeah,
interest rate, yeah,
just have a question now on the highlighter that you have. It say rent, and
yeah.
the one idea say fee.
Well, it is a fee that's charged to you,
Okay.
but they're just giving you another way to look at it, to consider, when you borrow someone's money, what is interest? It's a fee you pay for the use of someone else's money. Another way to look at that, it's uh, you don't get to keep the money. You're only renting it. So interest is the rent, the charge, the fee that you pay for using someone else's money. So they're not letting you have it for free, right? They're not just giving you the money. You got to pay it back, but they're also charging you a fee, the rent to use it, and how long you pay it, it takes you to pay it back will have a different rent amount that you pay, so to speak, right? That interest could be of a different amount. What are some of the things that affect the interest rate you're charged?
Your
Wait,
credit
what?
score?
Okay. They call it, let me start off by saying this. They call it risk based lending for a reason. Okay. And Jonathan, you just said the credit score. Yeah, the credit score can play a big role in how much you pay because what does your credit show? It shows your history of paying back your debts. and your likelihood of doing so in the future can be based off of your history of doing so. So that's one factor. What are some more factors that affect the interest rate that the lender charges you for borrowing their money?
The market.
Uh, well, I guess whatever the applicable federal rate is in the economy right now,
Yeah.
because the lender marks it up based off of that, and that fluctuates as the market does. What else? Like what affects your interest rate, like your what they charge you versus what they charge me for borrowing the same money to buy a house? You said the credit
Credit.
score already.
Your debt to
Yep.
income.
Um,
The DTI, your debt to income ratio. Okay, what else?
um, I'm thinking like ability to pay. So maybe like your salary or your other obligations.
Well, that's your debt to
That-
income ratio. Your
Oh,
debt to
shit.
income ratio, they look at how much money you make in relation to your current outstanding debts. If you're
Okay.
already kind of maxed out spending everything, how are you going to be able to afford to pay off additional loans, right? So your debt to income ratio, they take into consideration. They take into consideration your credit score. They take
Mhm.
into consideration the value of the house in relation to the appraised value. They take into consideration how much money are you putting down? Are you putting
Mm,
down any? Right? Anything that causes more risk to the lender will raise the interest rate that they charge you. The less risk to the lender, the lower the interest rate you'll get. Right? So there's a lot of factors that play a role into that. Okay, let's continue on. Interest rates that are charged by lending institutions on home mortgage loans vary as changes occur in the money markets. As interest rates move up, an established fixed rate mortgage with a low interest rate may be a plus when selling a home if the new owner is willing to assume the existing mortgage. On the other hand, if mortgage interest rates fall, homeowners may seek to pay off their loan and refinance at a lower rate. That's like what I said. President Trump has just been floating around recently the idea of having a 50-year mortgage, and people are like, 50 years? Well, I mean, he's limited in what he could actually do to lower the price of the home, but to make it more affordable to get into home ownership as prices are skyrocketed. Um, he has no control over the value of how much the homes cost right now. Those are individual homeowners do. So what he could do is lengthen the terms of loans. In the past, it used to be a 5-year loan in the 1920s. And then, what was it, President Truman or one of those guys? They raised it to 30. They introduced a 30-year loan.
He's also trying to do I don't know the name of it, but it's where you're able to carry over your rate um, with your loan. So if you have a 3.2 rate with your rate, you can purchase a new home at that same rate.
Which I don't know how he would do, but he's the financial expert with all the stuff that he does. So how he would go about implementing such things, I don't know. So I can't even speculate as far as that goes. But that's an interesting concept too. All these things contribute to, president's limited in what he could do, but I mean, he's trying. I mean, he's introducing a 50-year mortgage loan. What good does that do to anybody? Because a lot of people are mocking it and saying that's ridiculous. Well, was it ridiculous when Truman introduced a 30-year mortgage? Why not a 50-year? What does a longer mortgage, a longer term do? It brings down the monthly payment.
But you pay more at the end.
If you were to keep it for that full term.
Yeah, if you keep it for that time. Yes,
but,
absolutely.
But let's take a look at what they say right here. On the other hand, if a mortgage interest rates fall, homeowners may seek to pay off their loan or refinance them at lower interest rates. See, you could use that loan to get into home ownership, And then as you build equity over time, you could refinance and get a lower interest rate when interest rates fall, right? Interest rates, you could always refinance if those interest rates come down at some point in time. Now, to buffer the effects of an unstable money market, lenders have been offering many alternative forms of mortgages in recent years, such as adjustable interest rate mortgages. Seller financing gains in popularity in times of tight mortgage money when they're not lending, when the lenders aren't lending. And that's happened before. Look, when our mortgage markets were crashing and we were having all those massive foreclosures and stuff in 2006, 2008, 2009, 2010, there was a whole span of years there where the mortgage markets were crashing. And then we had a recovery that was agonizingly slow recovery, very anemic recovery for many years, because our administration didn't know what to do. Their answer was to throw money at the problem. What did we have? President Bush, he did a bailout, right? And then we had President Obama. He was the great hope. He had all these ideas, right? And what was his idea? It was the same thing as Bush's, except it was to have a bigger bailout. That didn't improve things. As a matter of fact, you had a lot of politicians on the right. They were screaming, okay, you're going to do the big bailout. Just give us a day or two where we could put a couple of rules in place on how that money can be spent. Because look at what Bush did. Bush did a bailout, and a lot of bank CEOs and presidents, they used that as golden parachutes. Remember that phrase, golden parachutes? Because all those existing money from those bailouts to pay back those lenders to prevent them from losing any money who may have lent their money for FHA loans. The FHA does not lend money. They insure lenders against loss. That's the Federal Housing Administration. They insure lenders against loss. They say, banks, lend them your money, and we will insure you against loss in the event the borrower defaults. We'll pay you back everything, make sure you don't lose a penny, and we'll foreclose and gain ownership of that property. Okay. So they did that. And then they went bankrupt because the FHA ran out of money because there was so many loans that people were getting foreclosed on. So Bush did a bailout. And then we learned from that a lot of CEOs now shows that there's a lot of money, extra money in the banks. CEOs get paid based off of the balance of the money that's in their banks. It's usually a reflection that that's their profits, and they're doing very well, even though that wasn't really the way the profit went down because it was a bailout. So we learned, and we had some politicians that tried putting into place rules that said, stop, wait a couple days, just for us to put some rules into place on how lenders can use this money that requires them to use it to lend, so that they don't just sit on it as a safety for their that they have to actually lend them money back out to the public again. And that CEOs can't use it as golden retirement parachutes for bonuses to be paid out to them. And then Obama was like, well, we can't do that. We got to put that money out now. We know there's going to be waste, fraud, and abuse. The sky is falling and all. And we got to, that money will trickle back down into the economy, which is actually pretty funny that he said that, because isn't that what they're always accusing Republicans of, the trickle down economics, which is actually a made up concept. There's never been trickle down economics in our nation or used anywhere. That was just an accusation. But anyway, I don't want to get into that. But this is what happened. And then the lenders were not lending at this time. So when lenders aren't lending, how do you buy a house? So to buffer the effects of unstable money markets, lenders have been offering all kinds of alternative forms of mortgages in recent years, like adjustable rate mortgages, which they actually shift the risk or reward of rising or falling interest rates to the borrower. Seller financing becomes popular in times of tight mortgage money when the banks aren't lending. And for years, potential homeowners have been able to receive assistance in obtaining low down payment mortgage loans through government programs like the FHA, the Federal Housing Administration, which does not lend money. They insure lenders against loss. They say, bank, lend this borrower your money if they meet these criteria, and we will insure you against loss that if they get if they aren't making their mortgage payments, we will foreclose on them and take the property, and then we'll pay you back every penny to make sure you don't lose a penny. Okay, and that's what would happen a lot. And then we have the VA, the Department of Veterans Affairs. They give loans only to veterans, and those loans they're guaranteed 25% in the event the borrower defaults. And then they would foreclose on that property from the veteran and then pay back the lender 25%, as if the borrower put down 25%. That veteran borrower put down 25%. So often those VA loans are 100% financing. The veteran's not required to put any money down because the VA guarantees 25% of it. In addition, private mortgage insurance companies have been offering programs that enable loan applicants to receive higher loan to value ratios from private lenders than they could otherwise obtain. Because traditional banking theory says that if a lender loans you more than 80% of the value of the home, a higher than 80% LTV, they're risking their depositors' money. So they would still lend you the money, but they would require the borrower to get private mortgage insurance, PMI. And PMI, what is that? It insures the amount less than 20% that the borrower put down. So if the borrower put down 15%, if the borrower only put down 5%, it would insure the other 15%, the amount less than 20% that the borrower put down. It does not insure the entire loan. It's not life insurance. PMI, private mortgage insurance, only insures the amount less than 20% that the borrower put down. So we have interest rates. They change. Once again, this is just a recap. Interest rates change and fluctuate in the money market on a regular basis. And when interest rates are high, alternative forms of financing could be more attractive, like adjustable rate mortgages or seller financing, or those government programs that could allow for a higher loan to value ratio, meaning they lend you more money, but the borrower puts down less. We have those programs through the FHA that are insure loans, and the VA who guarantees loans to veterans. We also have state programs through the New Jersey Housing Mortgage and Finance Agency, the NJHMFA. They've got all kinds of programs for first-time home buyers, for teachers, police, and firemen, for people who work remotely from home to relieve some of the congestion on our busy roads. They also have programs from the USDA. Yes, the USDA, those ones that inspect our meats and foods and stuff. They have something called the REC-D, the Rural Economic Community Development, where they give loans to people who live in rural areas, not just to farmers, but people who live in rural areas. It could even be on Indian reservations or just people who live in rural areas. You could get 100% financing from them even today, and they do lend directly. All right. So since I mentioned the word rural, you guys know the difference between urban, suburban, or rural? Well, I drew a little picture here. An urban area is a densely populated area. You have many people living within close proximity of each other. Suburban area is suburban. You have people living a little bit further apart from each other. This is like 1 and 2 and 3 and 4 family houses, not all high rises and apartment buildings. And then you have rural areas. That's like living out in the country or farmland where people live farther away from each other, where you may not even be able to see your neighbor, you know? That's a rural area. A sparsely populated area, like farms or neighbors far away or out in the countryside. Okay, so payment plans. Let's go over now payment plans. There's all kinds of payment plans out there. We'll talk about fixed rate loans first, where the loans are not adjustable. When you get a loan, it's at a fixed interest rate for the entire term of the loan. Okay. So these are known as amortized loans. The word amortize means to kill off slowly over time. So the word amortize means to kill off. So therefore, a fully amortized loan means that it's fully killed off by the time over time, by the time you make the last payment, that loan's been fully killed off. The payment amount does not change. It remains constant. Your first payment to the last payment remains the same on a fixed rate loan. The only thing that changes is how those payments get applied. Payments get applied first to interest owed and then the balance towards the principal. What is the principal? That's the amount you borrowed. So over the term, whatever the term is, whether it's a 10, 20, 15, 10, 15, 20, 25, 30-year loan, 40-year loan. We actually do have 40-year loans. They're just not that popular. So it's not too crazy the fact that President Trump is now trying to introduce a 50-year loan. All right. And by the time the last payment is made, the loan's been fully amortized or fully killed off, and your balance is zero. So in a fully amortized loan, your monthly mortgage payment gets applied first to what?
Interest.
It first gets applied to the interest, and then the balance gets applied towards the principal, the amount you borrowed, to start paying down that amount. Now, a straight loan is an interest-only loan. You're only paying interest. You're not going to ever pay off this loan by making mortgage payments, because a straight loan is an interest-only loan. You're only paying the interest payment each month. You're not paying down the principal at all. So therefore, these are usually short-term loans for specific purposes. And interest-only payments, you'll never pay down the principal. So it's often used for second mortgage loan as a bridge loan, for temporary financing. If you own a house and you're buying a new home before you complete the sale on your existing one, most people cannot afford a mortgage payment on two homes. So in real estate, what we as real estate agents usually do when somebody's selling one house and buying another is we try to close on their existing home within 30 days of the sale. We try to close on their existing home, the sale of that, within 30 days of their purchase of the next home, so that they don't have to make a mortgage payment on two loans. But that's not always possible. Sometimes people have to move forward with the purchase on the next home before they even put the next other current home on the market. So we could get these short-term loans that'll help them swing the payment in the interim until they sell their home, so that they don't have to make mortgage payments on two houses at once. So this is often referred to as a bridge loan, swing loan, or interim financing. It's a short-term loan usually not meant for more than 6 months, but they could be as much as a year, but they're usually not more than 6 months. And we also have straight loans that are used by builders or investors who fix and flip homes. Those loans are meant to be temporary, just until they finish the house, and then they'll turn around and sell it and pay off the amount they borrowed in full. But until that happens, they're going to have to make mortgage payments. So they're going to make the smallest payment possible until they sell it. And they could do that by paying interest only with an interest only loan, which is known as a straight loan. Any questions on any of this stuff so far? Are we all good?
All good.
Okay. So let's do some highlighting of what we explained so far about amortized loans. The word amortize means to kill off slowly over time. And regular payments are applied first to the interest owed, and the balance applied towards the principal over the term, whatever the term may be.
Got it.
Okay. So we went over the word amortize means to kill off. Fully amortized means you fully killed it off. So therefore, partially amortized means by the time you make your last payment, you've only partially killed off the loan. So what does that mean to us? That means you're going to have to make another payment to fully kill off that loan, to put a final bullet in the loan, right? To kill that loan by making a larger payment. So in a partially amortized loan, you've only partially killed off the loan through your payments. Periodic payments, they don't fully amortize by the end of the term. At the end of the term, there's still a balance. So that last payment has to be larger than the rest to fully amortize it, to fully kill it off. That larger payment, that larger last payment is called a balloon payment. Why? Because like a balloon, it balloons in size. Make sense? Now, why would you want to get this type of a loan that doesn't fully amortize it and the last payment is much larger than the rest? Well, because then throughout the term of the loan, your monthly payment is smaller. Now, here's an interesting one: biweekly mortgages. Many people misunderstand these. They misinterpret them as you having to make a mortgage payment every 2 weeks. That is not what a biweekly mortgage is. A biweekly mortgage consists of half payments every 2 weeks, the equivalent of 26 half payments per year, or 13 monthly payments. Wait, how many months are there in a year?
There's 12, but because of the there's some some months that have an extra.
Yes. So therefore, it equates to 13 monthly payments that you made in a year. That one extra monthly payment gets applied entirely towards the principal, paying down just the debt that you borrowed, not the interest. If you do this, that could reduce the term of a 30-year fixed rate loan by 7 or 8 years, where you could pay it off in 22 or 23 years instead of 30, saving you approximately 8 years of mortgage payments. That sounds like it's a lot, doesn't it?
Oh yeah.
So you could do this either by setting it up as a biweekly mortgage. So this is for people who have trouble saving money and then making one extra payment per year, applying it only towards the principal. Those people who have money in their pocket that's burning a hole, they got to spend it or have trouble saving it. It becomes kind of transparent to do it this way. If you make a half a mortgage payment every 2 weeks, it's like taking the extra change in your pocket and sticking it in a bucket. And then at the end of the year, you're adding it all up and wow, I saved a lot of money. And then you use all that money to make a mortgage payment and
Now,
applying it only towards the principal.
if
Not
you are you able to just do that, just make one extra payment, and it still
sure.
equates to the same thing where you still save the 8 years?
Yep. As a matter of fact, if you're able to do it at the beginning of the year, you save even more money because throughout the rest of that year, they're only charging you interest on the balance. So if you at the beginning of the year you made one extra mortgage payment entirely towards the principal,
How do you do that?
you got to have the money. You got some money in
What?
your pocket.
No, no. I
Yes.
mean, I know how to that you got to pay it, but is there a specific thing that you tell the mortgage?
Yeah. Okay. Yeah. So
You got it.
if you send in your payment by check, on the check, you must write apply to principal only. Because if you don't, they're going to apply it to the interest only. And then they're going to be like, next month you don't need to make a payment. What is interest? It's the rent to borrow the money. So basically, you're paying rent in advance. Don't do that. Don't pay the rent, pay the principal so that you own it quicker, right?
Yeah.
So that's if you're making a payment by check. These days, a lot of people make their payments directly from their bank to the mortgage online.
Yeah.
And when you're making your payment online, you could select in the drop down, you could select or drop down or check boxes. You could select that you want your mortgage payment, the excess money that you're paying, if you're paying a little bit extra, you want that. How do you want it applied? To interest only, equally to interest and principal, or only towards the principal? Apply it only towards the principal for crying out loud.
Yeah.
Right? Yeah, that's what you want to do. Okay, you could save a lot of money and by doing this. So let's do some highlights there for fixed rate, straight loans, the balloon payment, and the biweekly mortgage stuff. Are on page 268 and 269. Now I did the math and it's coming up on a slide in the next slide or two. I'm going to show you an example of how much money you could actually save if you have a $300,000 mortgage loan at a 5% interest rate for a 30-year mortgage loan. If you pay it off only 5 years sooner, how much will you save on interest payments? And it comes out to over $50,000.
Wow.
Yeah. Yeah. Wow is right.
Imagine if you do two. By
Make
the
two mortgage
beginning of every
payments.
year, like you do two mortgage
Well,
payment by the
yeah, it's whatever you could afford, though. Depends on how much money you're making, how much you could sock away and save up to make that extra payment. But if you're able to do it, yeah, it could save you a tremendous amount of money. Y'all got the highlights? Everybody good?
Yes, sir.
Yes, sir. I got it.
Okie doke. So, oh yeah, here it is right here. So here's a comparison I do, which I'm going to teach you probably later on in this chapter. You'll see it again, but this is just a quick thing, just so I could show you. And this isn't even by making the extra mortgage payment, the biweekly mortgage. This is just comparing two different loans altogether. A 25-year loan versus a 30-year loan that are both at a 5% interest rate for 300,000. You save actually $53,460 by paying it off 5 years sooner. But that's if you set up a 25-year loan and make the payments on 25 years versus a 30-year loan. You could save even more if it's a 30-year loan and you make that extra payment. It's the savings is even more. That's something.
Yeah,
Isn't this a
it's-
shocker, though? Take a look at these numbers. If you were to keep a 30-year mortgage loan at a 5% interest rate for a $300,000 loan, and you were to keep that loan and just make the payments on it throughout for the next 30 years, you would have paid $579,960. So $279,960 in interest payments to borrow $300,000 at a 5% interest.
I wonder why the lenders always lending money.
Yeah, I want to be a lender. That's right. Yeah, you got that right.
Buy houses like that, you're already a millionaire.
That's insane. All right. So let me ask you a question here. I got this little news clip here that will answer this. This is from, remember I told you guys, I don't care what news station you listen to, what news it is. A lot of news is partisan. But if you want the more accurate news that's less partisan, look at the business news channels, the business networks. Some of them you could tell, if they're business news, you could tell when they're being partisan because they're not talking about the money and the facts and figures anymore. They're talking more about politics. Look at these guys right here. This is Newsmax but this is a show about finances, and they've got a couple of people on here from Monty Huddle talking about, would you save more money? Which one would save you the most money? Buying a home at a lower price or getting a loan at a lower interest rate? What do you guys think before I play it?
Getting a loan at a lower interest rate.
Kev, what do you think?
What was the beginning of the question, though?
So, would you save more money by buying the house at a lower price or getting the loan at a lower interest rate?
I mean, I think it also depends on
I would say
what the price is versus.
Okay, so Kevin's lower price, Jonathan lower interest rate. Now he's starting to crack a little bit and says depends. Okay. So let's find out.
Yeah, hey Seth, I want to ask you something about the housing market. My wife and I are looking to buy a new home. I've read that the housing market is in a recession, and that maybe, and I've been told by various people, hey, no, hold off, don't buy right now, that prices may be inflated. Is the housing market in a recession? Is now not a good time to buy, or is it? I don't know.
It's a broader question, John, and a lot of it depends on where in the country you are. What we tell people all the time is what you want to make sure you're not doing is overbuying house. If you're looking at your interest rate right now, and to Dan's point, that inflation is what's causing interest rates to go up because the Fed's trying to get that under control. So you've got this compounding issue in the housing market. The problem you got, I would say the one thing you want to focus on is you can refinance interest rates. You can't refinance principal. Principal, whatever you pay for that house is what you bought that house at. Now, in certain pockets, maybe where you are in Miami, where I am in Texas, not where Dan is up in New Jersey, I think in our neck of the woods, prices are going to stabilize. They may not go up as fast, but I think they'll still continue to go up. Maybe not even drop. If you're in a cash position, that's great. If you're up where Dan is, I think they're going to drop. So you might have a buying opportunity. But where we are, I think you might want to, if you find the right deal, get it. But plan to refinance as soon as interest rates do drop.
Yeah, Dan, I don't know where you are, but I read recently that Jersey City has now become the most expensive city in America. I used to live in Jersey City, and boy, I wish I would have bought when I lived there way back 15 years ago, whenever it was. Seth Benson and Dan Geltrude, I appreciate you guys coming on for Money Huddle. Appreciate it. Have a good day.
So there you go. Buying the house for less money will save you more money, if possible. Now, one thing they said, they think that the housing prices may go down here in New Jersey, but this was about a year ago. They have not gone down; they've continued to go up. So, but they are right with that, though, that interest rates, you could always refinance down the road if interest rates fall. But whatever you purchased the house for, well, that's what you owe. There's no renegotiating on what you owe. Whatever you buy it for, that's what you bought it for. So if you could get it at a lower price, that'll get you more savings than concentrating on an interest rate, because you could always just refinance if the interest rates ever drop later on in the future. So here's a bar that there's a graph here that shows you each one of these lines on the bar in this graph represent 1 year in a 30-year mortgage. And the dark color of a bar indicates your mortgage payment. So in the first year, your mortgage payments get mostly applied towards the interest. And the light color here at the tippy top of the bar, that's how much of your monthly mortgage payment gets applied towards the principal, pay the amount you borrowed to pay down your debt. For at least the first half of a 30-year mortgage, where does the majority of your mortgage money, your mortgage payment go? It gets applied towards the interest, not to pay down the debt, the principal. So that's why if you make that extra monthly mortgage payment, applying it only towards the principal, you could reduce how much they charge you on interest. Now, how come they do it like this? Why don't they just set it up 50-50, that throughout the whole 30-year mortgage, your monthly mortgage payment gets applied evenly, half of it towards the principal, half of it towards the interest? Why do they do it like this, that for the first half of a 30-year mortgage, the majority of your mortgage payment goes towards the interest rather than principal, or not doing it evenly? I mean, they could do it and still make the same amount of money. So why do they do it like this? Why do they charge all that interest up front?
Because that's how they profit. They don't profit off of the mortgage.
Yeah, but they could make the same amount of money if they were to make it 50-50. Your monthly mortgage payments for the whole 30 years, half of it goes towards the interest, half of it goes towards the principal. They can make
Because if you default, at least they got most of their money back.
Okay, so maybe in the event of default, they want to get their money up front. Okay, give me another reason.
If you decide to sell,
Okay, how long on average do people stay in their homes when they buy them these days?
these days, I don't know, maybe 5-10 years.
The average is 5 to 7 years. It's not like your parents or your grandparents, where they would raise generations of kids in the house.
Yes.
And that was the family home. Now it's like we live in a nomadic society. Everybody wants to be a boss, so they're always moving for work. You don't need to live by the factory where your like your parents, where they lived at the near the job site where they worked all their lives. So that's why they plant their roots and they stay there and they raise their family. Now we got people that they're moving constantly for their jobs, for their work, for everything, and they're become more of a nomadic society, especially since societal norms have changed. We have less what they call nuclear family. I don't know why they call it a nuclear family. You know what a nuclear family is?
No.
I think it's the dumbest saying. For the longest time, I didn't know what the hell it meant either. It means that you have a mother and father. Okay. You have a family unit that's all together. But these days, it's more common where you have single parent families. They don't get married anymore. You don't have a family unit. You got like a lot more single mothers. So they don't have your traditional house. Maybe they're buying condominiums because their money is stretched a little bit more, or they tend to move more often. The society, as society changes, so do the real estate, the way real estate works. We don't plant seeds and grow generations of families here, where you got your parents, both of your parents raising the children, and then they have kids and they may even grow up in that same house as well. You know, we're quick to get the hell out of the house and away from our parents, and be on our own. Even though New Jersey is actually the state that happens the least. I just seen a report on this the other day. New Jersey is actually the state with the most children who do not leave home; they stay home. Now, it's probably because real estate's also the most expensive here in New Jersey. You know, cost of the costs of have gone up tremendously of inflation in New Jersey.
Those
Taxes have
taxes.
gone up. Oh, those taxes are killer. It makes it hard to get out and live on your own. It's easier when you have a couple or a couple family members or even friends living together, to cover those expenses if you're to move out of your parents' house. It's hard. It's hard to move out on your own in New Jersey. It's expensive. What's the average sale price in New Jersey for a home?
525.
Actually, we saw something about this earlier, didn't we? It was like it was in the 500s, mid 500s to somewhere around there. Yeah, but you're also seeing a median price, well, average median. You're seeing a lot more homes now starting to creep up towards that $600,000 range on average. But yeah, we're right now we're in the around the mid fives. So $500,000. When I was growing up, I couldn't even imagine a number that big. Then again, we also didn't imagine that our country would be having an annual budget of over $1 trillion. Trillion. What is a trillion? I can't even. That's number so big. I can't even. Trillion. I thought a billion was a lot. Trillions even more. Can you even imagine it having $1 trillion? What is it? What is it like? Trillion. I mean, really, we know the numbers. We know how they work. Billion, million, billion, trillion. But can you actually recognize that number in your head? Like realistically, what is $1 trillion? I mean, I know it's a lot, but I mean, I can't even rationalize $1 trillion. It's so much money. All right. So now we get into adjustable rate mortgages tomorrow. It's already 4:30 or 4:35. So we'll continue chapter 14 tomorrow. So let me